The FDIC just reported the California regulator shut down Silicon Valley Bank.
Biggest failure since 2008.
Dragged the whole market down 1.5%. And then yesterday, another one, Signature Bank of New York.
I said, you're not hearing me. Get the money out.
Banks collapse over the weekend. Is this an isolated event, or is this the start and just a crack in the dam? I dive into the 3 most important takeaways, why this matters to you even if you don't have deposits over the $250,000 limits. Number 3 being the most important to you. Over the last few days, Silicon Valley Bank and Signature Bank were taken over by the feds. One of the most critical factors in this was 97% of the depositors, the accounts, had over the $250,000 FDIC limits, and people were freaked out. To give you some context, many businesses have over $250,000 in deposits in the bank to prepare for lean months or float out uneven cash flows. But if all of a sudden you woke up and your bank went under and your money was gone, it would cause a seismic shift in pressure on the entire banking system as a whole. There's lots of speculation over the weekend that everyone with over that $250,000 limit was going to lose their funds or be tied up in bankruptcy court for years. Number 1, the first point was the Fed stepped in and backstopped all depositors, even if they were over that $250,000 limit. This means that even if the bank collapsed, the shareholders and the bondholders and everybody who was invested in the stock price, they got wiped out, but the depositors were made whole. This became a critical component because that would stop a significant run on all regional banks if there was ability that you could lose your deposits over that $250,000. So that was an amazing step up and a win for the Fed to help maintain some structure to the banking system. Number 2, being that the Fed literally last week was talking about another 50 bips or 0.5, a 0.5% interest rate increase. So since that time period and having some of these banks collapse, there has been speculation that there may not be that same interest rate rising announced this coming week. It may be only 25 bips or might be 0 altogether. So this becomes a big critical factor is because the market had already priced in a 0.5% increase. And so you may see stock prices in some areas starting to go up, or this is triggering and signaling the end of the QT component, the quantitative tightening policy of the Fed, because it is putting too much stress on the overall financial system as a whole. This is the number 3 biggest thing, as if the Fed had not taken action, and why it is important to you. The most important and key factor of this, by backstopping and not allowing the depositors to lose out their capital over that $250,000, essentially stopped a run on the banks, all regional banks. So even though if you're getting lending from a credit card, or maybe it's you're getting bridge financing, or you're getting a mortgage through a mortgage brokerage, even though these aren't directly through a bank, there is second order and counterparty risk, is because they oftentimes get capital from banks. And so they secure warehouse lines or line of credits or other things. And then that does effectively stop lending if all of a sudden they're concerned that their depositors are going to be withdrawing money. Say I have $1 million in a bank and I go and call up the bank and say, give me $1 million. Guess what? That bank is not going to be lending out $1 million to someone else. They're going to be canceling all those lines of credits. They're going to be freezing warehouse lines. Their risk analysis is, we're not going to put more money out there. We're going to be concerned about having to pay out these depositors. And then what you would see is a seismic issue with all lending moving forward had the Fed not stopped in. It doesn't matter if you have a credit card, you're trying to get a car loan, you're trying to get a mortgage, you're buying a multifamily building. If the Fed had not stepped in over the weekend, you could have seen all lending come to a screeching halt. And that's why it is most important, even if you didn't have $250,000 or over that $250,000 limit in Silicon Valley or Signature Bank, this could have affected you in a very, very dramatic way. What are other things that you're curious about in the potential run out of this? If your bank was to collapse, what would happen to you? If you want to know more, put down in the comments. Ask some of those questions. We're going to be doing a lot of this week, diving into this content more and more.